So today I'm doing the UK stocks I'm buying June 2024 edition. So this is a series that I've done on the YouTube channel for many years now, and it just keeps with that transparency so you guys know what I'm buying and what I'm selling in my UK portfolio. Now I will do my US portfolio in a few days time, but any stocks that I've bought and sold from the 1st of May to the 1st of June will be on this list today, and it just helps you guys to track along with what I'm doing in the stock market and just keeps up that transparency. So any moves that I make are on this video here, not like other YouTubers that sometimes will buy something and only talk about it if it works out, or sometimes if they have a stock that doesn't work out, they'll try to sell it out quietly in the background. We don't do that on here. If I've made any moves, they're always on these videos, guys. So I hope you enjoyed the video. It's always a popular one, so if you could hit the like button, and let's get started. And as always, if you do want to join the Patreon, a link is in the description. £5 a month. On there, you get to know what I'm buying and selling in real time on there. And just let you know, I might actually buy a brand new UK stock in June. So if I do, you'll get to know that on there. It's a move that I'm thinking of doing next week. And as well as that, you get 2 exclusive videos a week on the Patreon as well. And for £5 a month, the price of a pint, it's not too bad at all. And if you want some free shares, join Trading Them 2 with the link in the description. You can get a free share worth up to £100. Personally for me, that's the investing app that I use to buy and sell all my investments. Now let's get on to these stocks. So the first one I'm buying is Watches of Switzerland Group. So this is a turnaround play. This is a company that has done pretty poorly in the last few years, but I think they're going to start moving in the right direction. Financially, they haven't been doing that well, but I think that will start turning around going forward. So if you have a look here at the moment, it IPO'd around 2019, and the stock is a little bit higher than where it was after its IPO, which was nearly 5 years ago now, actually, nearly bang on 5 years. So it's had a really tough time, but there was a time the stock was doing really well in 2022. Well, since that time frame, it has been on a massive downtrend. The stock is still to this at the moment down 71%. Now it's a 1 billion, well, nearly a 1 billion market cap company, 9 times earnings, and recently I got in a couple of weeks ago, and I started buying during this time period during May. Now, since then, the stock has had a bit of a bounce up, so I am up on my position a decent amount, I think like 14-15%. But even though I'm up a decent amount, I did continue to buy the stock. So when this big rally happened on this day, I did buy some more at £3.80 and increase my position. They brought out a trading update which was really good, which I'll show you in a little bit, and that just gave me that confidence that the turnaround is starting to happen in the business. Now, first of all, what do they do? Watches of Switzerland, they sell luxury watches like Rolex, for example. And really, your only way to invest in something like a Rolex is by Watches of Switzerland, because obviously what Rolex don't sell directly to the consumer. Now, they have actually bought a watch retailer recently, but they still don't sell directly to the consumer. They sell through partners like Watches of Switzerland. Now, luxury goods have struggled this year. You look at Nike, for example. I was looking at Kering the other day, which own Gucci. All luxury good consumers, or sellers should I say, have struggled massively. You can see here, US direct to consumer luxury spending was down 7% last year. So it's been a really tough time. And if you look at the price of Rolex, for example, or used Rolex, look at the chart at the moment. It's really struggled, and that really peaked during 2022, and since that time frame you can see the price has really dipped, which if you were to put that next to the Watches of Switzerland stock chart, it would look very similar to the Watches of Switzerland stock chart. So you can see here they're both linking up perfect. Now I think that we have started to slow down this decline that we have at the moment, and we are starting to create a bit of a U shape in the bottom of the Rolex market, because obviously they can't go down forever. You know, historically these do go up in value, as you can see here. So I think we just had that 2022 where everyone in 2021 had all that free money. Everybody was buying luxury goods. People that wouldn't normally buy the luxury goods were buying the luxury goods. So we've had a bit of a reality check on the prices, and I think we are getting towards the bottom now, and we're starting to hit that more U shape in the watch market. And I think I'm going to get a quality luxury good company now at a relatively lower price. And the recent update that came out kind of confirms that maybe we are getting close to the bottom here. If you look here, the year finished off with strong sales, which was totally different from the start of Q1, Q2, Q3. They were troubling times where there was profit warnings coming out, but there seems to be a fairly big rebound, especially in the US sales, where US sales were up 14%, which is really good. They've launched their Rolex certificated pre-owned as well, which seems to be doing very well, and their long-term guidance is to hit double sales and adjusted EBITDA from what they're currently doing by financial year 28. Now, if they get anywhere close to doubling their revenue and adjusted EBITDA by the end of financial year 28, I can tell you something, guys. This stock will be not trading at 9 times earnings at a £4 stock. It'll be definitely a lot higher than that. Now, if we look at the full numbers, revenue was still a good 4% growth, as you can see here. Luxury watches was up 5%. The big weakness really has actually been in the jewellery category for this business, which they did see an improvement in Q4 in the jewellery category, as you can see here. Now, the US growth is actually doing very well. You look at the US growth, it was up 14% and 10% on a constant currency basis, with new launches in New York, a new store in New York that opened up. Now, if they continue the US growth, which is what they're focusing on, and this is massively growing, then I could see them really hitting them long-term targets for financial year 28. The weakness comes in the UK and Europe. As you can see here, they were down 4%. So we need to see a bit more of a recovery in UK and Europe, which I think will start happening as we start getting those interest rate cuts further this year, especially because inflation is doing quite well in UK and Europe. But the focus on the US, where it's still relatively strong at the moment, I think is very good for watches of Switzerland. So I think with their long-term game plan of their targets, of their growth, the US expansion, and 9 times earnings, this isn't looking too bad as a turnaround play, as luxury goods or luxury watches may be near the bottom in my opinion. So that's number 1. Number 2, Card Factory. I have decided to increase once again my position in Card Factory. So Card Factory is a stock that I've had for quite a few years now. I've had Card Factory for probably around about 4 years. First started buying during the CV times. The stock since then is up over 150%. I'm up around about 50% on my position in Card Factory, just because I keep averaging up and buying them more. And the reason why is because I think the stock is still massively undervalued at 7 times earnings, and the financials are just improving more and more and more, and that just gives me more confidence to buy it. Investors and Wall Street aren't fairly reflecting the progress that Card Factory has made on the financial point of view in the share price at the moment. I think this company should be more towards 12, 13 times earnings with the numbers they're doing. So Card Factory, I'm sure we've all seen a Card Factory. We've all got one on the high street near us. Obviously, they sell greetings cards and they're a lot cheaper. So we've had the cost of living crisis. Everyone kind of went, I'm not going to go get that £3, £4 card from Morrison's. I'm going to go to Card Factory where it's £1.10 and save a bit of money. People still want to send birthday cards, they just want to do it cheaper, and cheaper than the likes of Moonpig, for example. What they've also done is they've also added a lot into the gifts now, which have been doing very well for the business, and people are going, you know what, I'll go get them a cheap card, but while I'm there, I'm also going to get them a gift as well. And as well as that, they have added in a lot of longer term partnerships. So they've had new partnerships with like Matalan, for example, which have worked out very well. And they've actually gone back to increasing the stores. They haven't really been that aggressive on store openings, but they are now adding into the stores as well. So with the expansion into gifts, partnerships and new stores, the company has done very well financially. And if you do go on their annual accounts, which they just recently posted on the 30th of April, which was the kind of point of view where I went, okay, I need to go buy more shares in this. Revenue growth of 10% year over year. And let's not forget, we talk about a business here that is currently trading at 7 times earnings. EBITDA 9.5%, profit before tax was up 25%, net debt down 39%. Now this was the big problem with Card Factory. The balance sheet was awful, and the balance sheet now is actually getting really strong, which is very impressive. And they actually went back to paying a dividend, which was a 4.5 pence dividend. Now I think they've got a lot of room to hike this up even higher, but I don't mind that. I'm also waiting for the share price appreciation, but I'm also going to be collecting a really nice dividend. So if you look at the moment, that's around about 4.5% dividend yield, which is really nice. So as well as getting a, in my opinion, undervalued stock that's financially smashing it, I've got a really nice dividend coming up in this business. And like I said, the big issue with Card Factory is the balance sheet. But you look at the balance sheet now and look at the debt. We're down to 14.3% debt to equity. Now this was really helped by the whole COVID situation. The COVID situation forced them to stop paying this expensive dividend that was pushing them to bankruptcy, cancel the dividend, focus more on getting the profit up, and the profit then paid a lot of the debt down, and look at that now. Really good balance sheet, as you can see here. And if they keep going on the way they're going to go, obviously they're probably going to end up with a clean balance sheet and a dividend that's going to carry on getting hiked up. So yeah, I'm a really big fan of Card Factory, and I just keep buying it because as long as the financials keep improving and the share price doesn't reflect it, which if you look at the moment, year to date, it's flat after those earnings report, it's going to reflect it at some point. So I'm going to keep buying the shares up in that one. The next one was Jet2. So this is the first time I think I bought Jet2 for around about over 2 years. So it's a stock, once again, I've held Jet2 for around about 4 years. Bought during the whole COVID situation. I was up over 100+% on the stock. In fact, I think I've actually sold some shares out at 100+%. And yeah, I've not really bought for like 2 years, but I look at the share price. The share price has basically stayed flat since 2020. And the other day I looked and I thought, you know what? I actually think I could increase my Jet2 position here because I think the company is actually doing really well. The company trades at 7 times earnings, which I think is a little bit undervalued. You do get a 0.88% dividend with Jet2. But Jet2 is a budget airline, so it competes with the likes of EasyJet, Ryanair, but I think it's in a league of its own. I think it's a lot better than those other companies in this kind of sector. And that is clear when you look at the Which Awards. They got the Travel Brand of the Year, which is no surprise to me. I have flown with Jet2 and used Jet2 a couple of times, and they are by far a lot better than all the other kind of budget airlines, in my opinion. You look at Trustpilot, for example, 4.5%, which is 4.5 stars, not percent. And you can see here, that's actually really good. For a budget airline to have them sort of reviews, that's really good. You compare that to the likes of EasyJet, they got 1.4, and you look at Ryanair, 1.4 stars. So massively better than, they're doing better than them two companies there. So people are actually going to the point of view where they prefer to fly with Jet2 because they know that they're not going to get inconvenienced as much as these kind of other budget airlines. And as well as that, because so many people are choosing to fly with them, they're expanding massively. They're expanding their jet2.com site and the Jet2 holiday packages and announcing more locations they're flying to, expanding their airport locations, and that's clear when you look at the financials as well. Financials have been very good. Good revenue growth, as you can see here. Good levels of profitability, as you can see here. And for most airlines, they normally have horrible balance sheets. Jet2 is actually a pretty good balance sheet. 47.5% debt to equity, sitting on 3.2 billion of cash. Yeah, it's very good. So I like Jet2. I'm not normally a fan of airlines, but it's the one airline that I go, you know what, I can own this one. So yeah, I think it's about time the share price goes back to reflecting some of the financials here. So I did increase the stake by a good chunk in the month of May. The next one is Money Supermarket, or if you go by the new name change, MONY Group PLC. So I do keep increasing my position into this stock. Bit of an annoying one because it's a stock that I did start buying during 2023, but the stock kept going up and up and up, so I averaged up more and more. But really, it's really 2024. The stock has actually started going down. So yeah, but I like it. I'm a big fan of this company. I think 16 times earnings is pretty good for the business that you get in here. Lovely 5% dividend yield. So if the stock does nothing, you're still going to be picking up a 5% dividend yield, which is really nice. Obviously, comparison site, people getting more cautious about saving money, but as well as that, it protects them a lot, Money Supermarket, because if something was to go wrong with one part of the business, all the other part of the businesses help make up that thing that's going wrong. So, for example, during COVID, travel insurance was lost. Right now, we have the energy market comparison loss, which actually isn't even on here, to be fair. So everyone's comparing insurances because insurances are going up a lot at the moment, so they're doing well from the insurance business. So if you were to look at the numbers at the moment, if you look at insurance, for example, the growth is 21% year over year, and that covers for money, home services, travel's still doing actually okay, but it covers those kind of weaknesses at the moment. So everyone's always going to be comparing. But this company here is going to be well covered if there was any of an issue or a slowdown with one certain business. And one business that had a big slowdown and is still yet to come back for this business is the energy deals. So the switching market has been pretty dead for the last couple of years. The reason why is because they banned the ability to offer cheaper deals to new customers. And that all happened as the price cap and the energy crisis went absolutely crazy during 2022. Now, the ban is supposed to end in March 2025. Now, Ofgem are consulting whether or not to lift it 6 months earlier. I thought it would come even earlier than this, but it's good that they're finally doing it, but it should have been done ages ago. But obviously, if that is to happen, then the price competitive of, come to us, you're a new customer, we'll offer you this X amount of deal. energy market is going to get very competitive again. Now, the energy part of the money supermarket business was a huge part. They've lost a lot of revenue and profit because of this area being pretty much shut down. In my opinion, this is going to come back in the next couple of months, and we're going to have a big boom in the revenue and profit, because what we'll see is this home service business will do very well as the energy comparison starts coming back. Now, if you were to look at the numbers right now, in fact, if we go on the past performance, you'll be able to see the impact of the travel insurance, and then we had the energy switching market. But even without the energy switching market, we've seen the recovery in the financials, as you can see here. Revenue has increased a lot, as you can see here, and profitability hasn't improved as much because the profit margins dropped from 24% down to 16%. But if you imagine if the energy market does come back, it's like a light switch moment. The platform's there ready for the energy switching market. So if that comes back, that's going to contribute a lot more revenue, and the profit will rise and the profit margins will just increase because it's waiting there to be used. So that's where we'll see the company go back to 100 million plus in profitability, in my opinion. That will lead to a company trading a lot more towards 12, 13 times earnings, which I think is good for a company that's does these numbers, this amount of profit. Cracking balance sheet as well. We've got a good balance sheet, as you can see here, 50% debt to equity. And obviously, if they lead to more profit because the energy switching comes back, you're going to get a even higher dividend than 5%, which you get right now, which I think is already pretty impressive. So yeah, I think 16 times earnings for a 5% dividend yield, decent growth. You got the energy market to look forward to coming back, which will contribute a lot of profit and a nice dividend. I really like money supermarkets. So yeah, I think the big thing that I always consider is that how big do I make it? Does it potentially become a number one holding in the portfolio? That's where I do think about money supermarket coming anyway. And the last stock on the list is Gaming Realms. So I did add it into my Gaming Realms position, even though the stock has been on a very good rally and I am up on the position a good amount. I think I'm up around about 15% on my position. I do continue to average up on Gaming Realms because I still think it's a relatively decent valuation for this business. Currently trades at 20 times earnings, which is about the market average valuation, but the numbers they do aren't a market average numbers. They are brilliant numbers, and I think that they should trade to more of a 25, 30 times earnings, which is actually where it historically normally trades at. So I think it will get to there at some point. So Gaming Realms, they have a brand called Slingo, which is basically Bingo and Connect 4 together, and they have these variations, and also they have potentially work with teams like Detroit Tigers, as you can see here. And they also have like Deal or No Deal Slingo, which is a very popular iGaming product. And a lot of these iGaming brands, for example, like DraftKings, Entain, Flutter, use their product on their website for their iGaming, and they just take a cut of it. And it seems very popular. If you look at the likes of Paddy Power, for example, they even have their own Slingo selection on their website, and you can see all some of the variations like Slingo Space Invaders, as you can see here. And as iGaming grows through the likes of Asia and the US, for example, the US has so much growth ahead of it, they're going to just take more and more cut of the revenue and profit, and they should do really well. Now you look at the recent numbers, like I said, I thought the numbers were fantastic. Revenue increased 26%. If you look at adjusted EBITDA, that increased by 29%, as you can see here. Profit before tax was up 47%. And like I said, when you look at the company here, you're getting this for 20 times earnings. Like, these are not the numbers you would expect for a 20 times earnings company. You would expect a premium on this business here, and it's not happening at the moment. In fact, when I really started buying, it had a dip of these earnings, and it was at 16 times earnings, which was just unbelievable to see it below a market average valuation for a company that's doing these sort of numbers. But the company overall, very good growth as it's been expanding partners and obviously expanding into new countries. The profit they throw off is very good, as you can see here as well. They have a cracking balance sheet. If you look at the balance sheet, there's no debt on there, and they have a nice healthy cash position. So that could lead them to do things with the cash position that they do have at the moment. And that leads me on to the last stock on this list, which is what did I sell? I think I made a dedicated video to this on the YouTube channel, so it's no surprise to you guys, but I did sell my shares in Boohoo. Now, I'm not going to drag this on for 10 minutes because I could, and I think I did that when I did my video on why I sold Boohoo, but I did sell all my shares in Boohoo that I think I made a full video on a couple of weeks ago. So yeah, I sold, I took a big hit on Boohoo. However, it's probably important to point out that there was a time when I did own this stock, and I have owned it previously, and I did sell for 100% back in 2020, and there was also times during 2020, 2021 where I bought back in and I was selling for 50% profit. But I did sell on this dip here, which was a big hit, which wasn't good. Now, obviously, I sold Boohoo because I just thought, in my opinion, they're showing no signs of turning it around. I think the management team are inadequate. I still don't know how the CEO, John Little, has a job. I don't really like saying that about people, but he came in 2019. Obviously, the first 6 months, you just get your feet under the table. COVID happened, that helped the sales massively. And now really in the last kind of 2 years, it's actually, okay, what have you got as a CEO? And in the last 2 years, in my opinion, he's been adequate. He hasn't done a good enough job. And how he has still kept his job in the last 2 years, from taking the stock from where it, even before the whole CV situation, was a £2 stock down to a 34p stock, is sackable as a CEO. And I don't know how he's still there. I looked at the recent earnings they brought out and they showed no signs of improvement. Revenue was down 17%, the profitability was down 29%. Well, in fact, there is no profit, the losses were increasing. And when I looked at the report, there was just no signs of like, oh, this is what we're going to do different. They just continue to do the same thing and are expecting different results, which to me is just insanity. The fact that they just keep doing the same thing and just somehow expect it to improve isn't good enough. And you only have to look at the top apps in the UK right now to see why they're failing. Temu, number 4. You look at Shein, number 10. There's been the Chinese cheaper alternatives to fast fashion. Everyone has gone a little bit more conscious about, saving money. And for people that are more bothered about, saving a bit of money on the t-shirt order or the dress order, they rather save a couple of quid and they don't mind waiting an extra 5, 6, 7 days and they get it cheaper on Shein or Temu. And Boohoo just stood there and went, oh, we're just going to accept it and not do anything. They haven't pivoted the business at all. They haven't realised this cheaper alternative has come in and they go, okay, so either we need to go to a cheaper alternative ourselves to match them, or we need to pivot the business because we can't compete with these prices. And they just stood there and took it. And that's why they're being absolutely crushed. They didn't find a cheaper alternative to bring the prices down. For example, moving more to China to compete with the likes of Shein and Temu. And at the end of the day, they've got a customer base. They've had years of people's data that they still can market to, and people are choosing not to go shop with them. So they stood there and didn't pivot the online business. And then instead of going, you know what, okay, we can't compete with this online prices. Let's go to physical locations. We go to physical locations, we can charge a little bit more for that. And you look at Primark. If you do it right, Primark hasn't been affected by the likes of Temu and Shein. Maybe we switch to an online business model that we still have. And by the way, no decent app compared to Shein and Temu, for example. But we still keep an online business model, but we add in that physical location. And we try, 3 or 4 venues, Manchester, Birmingham, London, and we get them going and see how they do. And we see if we can get some generating some excitement through there. And you can, with them, they've got all these little brands as well. Imagine if they had like a Pretty Little Thing section there. When you've got like a Nasty Girl segment, obviously you've got the Boohoo Man. You could also add Debenhams. Imagine the excitement of if people heard that Debenhams were going to return into these, smaller locations inside a big Boohoo store. It would get really big media headlines, and yet they haven't successfully used that acquisition at all. And by the way, they've also absolutely created the balance sheet. So yeah, the fact that management team were just standing there and not doing anything was like, to me, like, I think this is going to go to 0p. So I might as well take what I've got left here and use it somewhere else. And that's all I'm going to say on Boohoo, because otherwise it's going to be a 10-minute rant again on them. So yeah, I did sell the shares in that one anyway. I hope you enjoyed the video anyway, guys, on the UK stocks that I'm buying. Let me know in the comment section what you've been buying, and I'll see you in a bit.